absolutely all-time highs, and I've said that even since last year. I can't remember my number for the Nasdaq just here, but the S&P is I think 6,100, 6,300 even, but 6,100 seems to be in the cards, and that to be reached within, let's say, next 6 months. So maybe into January or something like that.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Henrik Zeberg, who's macroeconomist, founder, and publisher of the Zeberg Report as well. So, Henrik, thanks for coming on the podcast today.
Thank you for having me on.
No problem. I'm really looking forward to our conversation because, yeah, it's been a really interesting year. And I guess if you look back at the start of the year, everyone was very bearish. They thought markets going to go down. They thought the economy was going to go, you know, go try not to swear, not do very well. Europe was in
Yeah.
trouble. But if we look to where we are now, things have, economies have been stronger than everyone thought. Markets have continued to go up. Apart from maybe the small banking crisis we had in the middle. So I guess from your perspective, what do you currently see in the markets? Maybe why do you think we have seen such a strong performance both economically and in markets over that period? Then yeah, we'll stick with that for now.
Okay. Yeah. So it wasn't too much of a surprise for me, as you may have seen also on Twitter, where I've been laying out my thoughts. And really, to me, it's an understanding of business cycles, and people do not really understand how the economy is not a speedboat. So it doesn't turn on a dime. It doesn't turn on a dime, up or down. It takes a while, and it's more like a super tanker. And when you see the massive at the point when we actually got into the to the Corona recession, I will call it, because it was just a 2 month kind of thing, and we had seen that the leading indicators in the business cycle have been turning down, and actually was indicating or calling for a recession to set in. And So I was expecting at that point that you'll see that some kind of deflationary development, and we did see that. And I also had a call on below $10 on oil, and that the bonds should be soaring and the likes, and we did see that. I actually thought it was a bigger thing, and that's probably where my thesis was a bit off back then. But when we then got back, we saw the first move up. We could start seeing that the improvement in the business cycle actually meant that this is going to be a little longer lasting, and it was not just a bounce and then it kept going. It was really a bigger thing, and this is where my structures then suggested that this could be developing into a blow off top. And I still think we are there. And this is what I really realized. I think it's more a year and a half, 2 years almost now, when we saw some of the structures telling me that this could become a longer lasting thing, and that we could get to levels in the market that nobody really expected. People then see inflate. I mean, analysts then saw inflation coming in, and then they were starting to say, okay, this is going to cause the markets to crash. And they did correct on that. And I will still call it a correction. It wasn't really a crash we had, even though we were below the 20% in an official bear market. But when inflation starts to come down again, and you understand the reasons why we had inflation, which was down to imbalances in supply and demand, well, then you would also expect markets to bounce up really strongly after inflation comes back down again, and as long as the economy is not in a recession. And this is where people really got it wrong, because they thought we were in a recession, or they kept, we have had many calls by prominent analysts around the world saying we were in a recession, whereas the indicators that I look at were clear on that we were not in a recession. That meant that when inflation come down, you will actually see this, what I call the Goldilocks zone, and assets should take off. And we haven't come full cycle on that yet. We were still in that phase. More to go, but we are obviously getting closer to the point where we could see, some corrections first of all, but later in the year also some European markets may be getting into a more severe downturn.
Yeah, and what are those economic indicators that you're watching to see, I guess, where we are in the business cycle?
Okay, so really, I've developed a business cycle model also with that based on leading, lagging, coincident indicators tell us where we are in that cycle. And if you look at some of the leading indicators, which are the money base, housing permits, and the likes, they were plummeting. So inflation were not good. We did see these were actually very bad. And these have been, for the last 6 months, they have been clearly stating that we're going to see something bad coming to the economy. What we haven't seen the follow through on some of the coincident indicators, which is employment, for instance. So the whole labor market's been way too strong. And we can understand that, because when we got out of the corona crisis, and the companies that, all the stimulus that they received, and everybody was making a lot of money, and everybody was building up capacity, and people were hired in, and now things are not developing really as they had been expecting. So people haven't, the employers, the companies haven't been laying people off just yet, but that will come at a certain point. But for now, the labor market has stayed really strong. And then you have the lagging indicators, which are the rates and the like, and they the rates are still high, but they will also come down when we start to see the coincident indicators. So I have a very a structured approach on how to observe markets, how to observe the economy and the business cycles, and they have been very clear on this. So for as long as we don't see a strong decline in the labor market and the strong deterioration, we will still have a market that can be going up.
Yeah, and I get, as you were saying there, the employee market is very linked to businesses and how they're performing. So are you thinking, especially with, you could say, Europe, with interest rates and the US being higher, and if they're higher for longer, that's going to, especially when these companies start to refinance and other credit that they need, that's when these companies are going to struggle, and maybe that's when we're going to see higher unemployment? Or what are the things that you think will occur there?
I think we have a normal cycle where we like to see that the higher interest rates that we have experienced over the last year and a half year, actually slowly starts to get into the economy in the way that, for me, for instance, if I have a mortgage loan, then you will see that that it's actually to this year that it started to play out. So the last 6 months I've been, having, higher payment per month, like, everybody else in the world. And that is the one thing that will slowly seep into the economy. People start spend less money, and that will then get on to the corporate earnings at a later stage, and then the corporation will then start to lay people off. So it's a normal thing, and it will go through the consumer as I see it. So I think we will see that, even though we've seen a bounce in consumer sentiment, I think we're going to see that come back down again. But it's a thing that goes hand in hand with the employment. So really, if it's consumption first or it's in employment first, whatever comes first, but it's going to get worse. And this is what I'll be looking at. I'm looking at the initial claims. I'm looking at the NFPs, obviously, to see that deterioration, which tells me that now, or the acceleration in those numbers, that tells me we are getting to a point where the economy really starts to tumble, because of the weakness we've seen. But so far, it's been keeping up. Even the NFP numbers that we had last week were sufficiently high for a bull market to continue to move, or to exist. Will we have a recession later on? Yes, we will, definitely. I mean, there's no doubt in my mind, and I think we're going to see it, come out in Europe first. Some of my models starts to point to a very big difference in actually how the economies are doing in Europe versus how we see them in the US. So I think we'll see again the US stand strong for a certain amount of months going ahead, but I think Europe by the end of this year can be in trouble already.
In Europe, is that linked specifically to Germany? Because I know, and that might just be me, we've been hearing quite a lot of negative data and almost like deindustrialization of a lot of the European countries as well.
Yeah. Yeah, so Germany, but Germany is such a big economy in Europe. So if Germany does badly, I mean, Denmark will do badly as well, where I live, and also we'll see that in France and Italy and elsewhere. So it's not just Germany; it's all of Europe, and I think there are reasons why that can be the case. Obviously, when we have when the recession sets in, we normally see that also, that we'll probably have that in Europe. Coming to Europe first, we'll start to see the weaknesses. So whether it's Germany in particular or any other European countries, I don't know. I think it'll be all of Europe, and then we'll see US, having those problems coming later, maybe early next year. So for a certain amount of time, getting into late this year, early next year, early 24, we will probably hear what we always hear, is that the US is dodging the recession bullet, Europe is tumbling, but we may see that the US will keep the rest of the world afloat, and then we'll see actually that does not happen, and then if we'll have the recession. And there are so many signals that the recession is coming to the US as well, that it's just a matter of time. And then there is the normal cyclicality of it, that we'll see that the money will start to flow into the US, which will also drive some of the market moves that I see we could have over the next 6 months.
Yeah, makes sense. So if we, I guess, try and put that all together, you're saying that next few months, potentially to the end of the year, we will see continued strong performance, and then at some point during that period or early next year, we might see that sort of a shift in that trends.
Yeah, and I'll be looking for something very particular, specific, because where the dollar goes, the economy goes in the other direction, so to speak. So if the dollar starts to move up again, like then we'll see the economy deteriorate. And my models points to that we're going to see the Dixie now declining to, let's say, 90 areas, which will be a very, very strong tailwind for risk assets for a long time, for that amount of time. And actually not until just when we reach that bottom, but also for as long as we stay below 95. We are currently at 102 now, and I think we're going to see let's see if we get a reaction today when we get the CPI numbers coming out. But I think we're going to see the Dixie start to decline from these levels here rather strongly, and that will be a very strong tailwind to risk assets going into late this year. Yeah, so a amazing run, also with the rates coming down, with the Fed staying away, and the Dixie coming down. Then we'll start to see that FOMO, and then remember, a lot of people or analysts are now starting to say, oh, we may dodge the recession bullet, and then they will get back in just the moment when they need to get out. So when I was bullish last year in October, people were saying, no, we're going to crash from here. And then, I said at that time also, and I stand by that the moment when I start to say, okay, I think it's time to get out, well, I think we'll have a lot of people saying, nope, the Fed got our back, the economy is doing well, and then you'll have it. And again, so it's always like that. Where the sentiment goes, you really do not want to be, because the majority of the sentiment is often wrong.
Yeah, I agree. So you're saying, I guess, next few months, really the higher risk assets are probably going to perform, and that's going to, probably lead potentially Nasdaq to all times highs, and it'd be interesting to see S&P
Oh yeah,
500.
absolutely.
Yeah,
All-time highs.
all-time highs.
Yeah, absolutely all-time highs. And I've said that even since last year. I can't remember my number for the Nasdaq just here, but the S&P is I think 6,100, 6,300 even, but 6,100 seems to be in the cards. And that to be reached within, let's say, next 6 months. So maybe into January or something like that. And again, I just don't base that on just one chart. I mean, my model is based on hundreds of charts that all point in one direction. And then we need to see the business cycle really start to roll over, and that's back to when I look at the initial claims, the NFP numbers, and then see that deterioration. And we are now in, let's say, 10th of August, and we haven't seen the job numbers coming down that strongly yet. What was the number? Was it 189,000 on the NFP numbers last week? Can't remember. I think something around that number. And if you look at it historically, you would have to see the NFP numbers coming down to, let's say, around 100,000, maybe dip down to 50,000 on the NFP for a couple of months before you actually start to see it. And we're not even there yet. So we easily got, let's say, 5-6 months on the business cycle. And also other indicators like the timing from the spike in the yield inversion to when the recession actually sets in. You normally have a gap of, let's say, a year and 3 months or something like that, just 12 months. And still we had that bottom in June of this year. So we got time before, historically looking at it, we got time before the recession should set in. And yes, the markets front run the recessions and the economy, but it doesn't front run it by, as people were saying, suggesting that the top we had in January of 2022 should have been the top in the stock market. That's simply ridiculous. That the economy, that the stock market should front run it by, I don't know how many months, 2 years almost. That makes no sense. So new all-time high, which will then be the time to, not exactly that time, but when we start to move up there, we'll have a lot of FOMO, and then it'll be time to get out.
And then what will you be, or what do you think people will perform? So what should people rotate into after that, or what will you be doing?
Dollar. dollar. I
Dollar.
mean, you look at it into. I mean, we're going to have a. I think we're going to have a liquidity crisis again. And if we look at some of the leading indicators and the strong decline we saw in that is actually pointing to a deflationary development, a very strong deflationary development. And I know, and I'm wondering why, and I put it on the show here on Sunday to my subscribers also, and said there are some strong indications that I hope that the Fed is also looking at. So the rate of change in terms of how fast have we seen some of the leading indicators come down, that is normally has a lag to what the inflation also. And just as what we look at right here and right now, I mean, inflation around one or below zero even, is already in the cards. And still the Fed came out and they hiked. I mean, there were no reason for that hike whatsoever. That was a pure, I don't know if it's panicking, are they panicking or whatever they do, or they want to play tough. I don't understand it. And they should also think that some of the things that they do is has an impact. So with the rate differential that I see also coming into between the US and Europe, I think into the recession, it'll be very, very wise to be long, first of all, TLTs and the likes, and also be long the dollar. And that would be my preferred, but only for a certain amount of time, because I think this cycle will going to be shorter when we actually see that blow off top in terms of the dollar and the TLTs, because the Fed and rest of the world will need to get back in terms of trying to weaken the dollar. Dixie at 120 is going to kill growth in the world, and that's the level I think we're going to reach by
Yeah.
next year, a year from now, let's say.
Yeah, and it does seem that like Feds and central banks they take actions a lot quicker these days than they used to in the past. So
Yeah,
as you said, it might be there for a short period, but then they'll do whatever they can to reduce that and to try and save the economy.
absolutely. They're going to try, and they're going to try again once more when, if I'm right in what I see, and with the recession, I mean, they have been successfully trying to or saving the economy by money printing and QE or whatever they call it. They will do that again. And I think this time around is going to be different. And the reason will be that, first of all, the economy will be in a completely different state than it's been ever since the financial crisis. We actually have a rollover of the financial system of the economy, and just applying more putting more money into it, the system will not necessarily make the economy bounce again. And I think even if it does, there will be a lag between when the financial assets is going to bounce. I think commodities will start to do tremendously well, but then we'll see the economy actually slump for a little longer. So I think they will try to do what they normally do, and that is not going to work as well as we've seen it done before. And that will put us up for a completely different situation where we will have deflationary bust first, but later down the road, I think we also going to see stagflation.
It's really interesting. And then I guess how does that affect debt? Because you'd imagine that there's so much both government and privates out there, so you imagine there'd be lots of defaults, and would that
Oh yeah,
further create deflation, or do you think that they're just going to print so much money and have so much fiscal support that that's going to create the stagflation?
I I think we're starting to see what we need to get to before we see the end of all of this, because just applying money or just spending money to the system actually puts on debt. So print money, and and inspires people to go borrow more, and that because then they will to spend it, and that keeps gives you a boost to the economy. The problem will be if people are start losing their jobs, and they will not be so as interested in starting to build their debt levels. So actually what starts to weigh down on the economy will actually be the debt levels here, not just from a private perspective, but also corporate perspective, and also from a national perspective, from a state perspective, you could say. And I think the only way around this will be to weaken the dollar, which I think they will try to do. And I actually see I could see some similarities what we saw up to the spike in the dollar into the mid 1980s, where we had the Plaza Accord. I could think we could see something similar to that at a certain point. But I also they also need to reduce debt levels, and there will we start to see this about forgiveness of student debt in the U.S. I think we'll see that coming to much more broad based around the world. I think we're going to see that in emerging markets as well. I think will be a lot of people and corporations that will need to restructure or to actually default on their debt before we get to the end of this. We need to get the debt levels down in order to get the economy to start growing again. And this is back to the contractive view on the world, where you need to have we're in the winter now. Everybody's, subdued by the amount of debt, which was kind of the snow on top of us. And we need to get that away first before we can start seeing the real green shots coming up from the from companies starting to grow, new companies and the like. So the debt levels is an anchor to the economic growth of the world, and that needs to come down. And one way to do that, and people may not like it, and it may not be seen fair, but that will be to wipe off debt. It will be to default on debt. It will be to restructure that. And I think we'll see a whole lot more of that. But we're not going to see that in the deflationary part. I think that will come when the stagflation is going to come set in, actually. So I think there is going to be a different phase to that. So let's see how that plays out. The end game of all of this is getting closer, and it'll start off with deflation and a small bounce at some point, and then later down, let's say 2 years from now, we'll probably look into a stagflationary situation. That will be really bad and can have consequences also on a societal level.
Yeah, so if we maybe focus on that debt forgiveness, I guess the challenge that a lot of people have is, and maybe if we look at what's happened recently, I guess the liability used to be held at with the consumer, or maybe with the company. They're the ones who are the most at risk when they default. I guess now you could say it's sort of gone on to banks, and they sort of have quite a lot of risk. So are they going to be the people who really suffer from this, or do you think the government's going to have to come in and basically write it all off?
Yeah, but I think it's still, I mean, even though we have seen some kind of fear here for inflation, I think still that the biggest fear for any national bank or any central banker in the world will still be deflation. And that means that, because if you start to see that spiral going, that's completely gets out of hand, then people will you'll have riots and things, and then there'll be a lot of reasons why, and they will also think that they need to backstop it, because obviously you don't want to have people lose their homes and in big scale. We don't want depression. So they will come back in when we see the deflationary bust start to develop. I only think that when they can backstop that part of it. And they will try and they will do it. But the only thing is that this time around, because the economy will be so sluggish and starting to move back up, and we did see some of that after the Corona crisis, where even though there were all the money in the world there, they just poured financial monetary and fiscal aid into the system. Still, you saw a very sluggish kind of turn in terms of people starting to spend after they, of course, they had this initial spending, but also the pickup of the supply lines. It took a while, and you need both to have demand and supply in balance before you actually start to see the economy going. And if we see something similar this time around, where we actually could see that people will be more sluggish and starting to spend money, maybe because I don't know what the situation is going to be. It's just that the situation could be that the economy will turn slower, and that can bring us into a stagflationary development. Because if inflation moves up and the economy starts to will be slumping, then you can have that stagflationary situation, and that will be bad for a lot of people.
Yeah, I agree. So, do you think the central banks, and I guess even the Fed, are they currently making the wrong decisions, and should they be cutting now, or what's your thoughts on that?
I mean, I think it was a big mistake from the Fed, absolutely huge mistake, and I think it's been in it for a while, and it just proves that I think they were afraid of their own shadow, that they have been printing so much money, and now they think, okay, oh wow, we let the genie out the bottle, and now they're doing everything to get the genie back in, the inflation genie. And I think they are overthinking their own power here, because it wasn't really what they did as much as the from the real economy, that you had a supply situation. You see that on the freight rates and the likes. I mean, this was not directly from money printing. This is when too much money is chasing too few goods, and there can be different reasons for that. They could be because you've pushed out too much money, which would be the money printing part, but it could also be because you actually had too few goods running around the system, and that was the case here because the supply chain broke down. So because of the Corona situation, so obviously you had people were willing to pay whatever to get their goods, and that's when you have these spikes in inflation. So, yeah, we that's the situation. I can't remember really what your question was, but that's what I think it could be. that was what we saw, and that was what they will be probably be seeing again. Sorry, what was your question actually?
It's about whether they've been making the right decisions with increasing interest rates. But yeah,
Oh, making right, yeah, sure. No, so they are notoriously behind the curve, and I think again here that being hawkish at this point here, where they could actually see some of the indicators are really coming down strongly, suggesting that if they understand the sequential system that we have in terms of leading indicators, coincident indicators, lagging indicators, they could actually see that the leading indicators are telling us we have way further to go in terms of the inflation coming down with the measures that have been taken already, and that's why actually getting in and trying to do more here, I just do not understand it. So they were wrong there, and I think they will be wrong again when they try to reignite the system, because they're gonna do one more time of QE, which would probably not be the right solution.
what do you think would be the right solution?
Well, I think that I actually do think that in the bigger perspective of things, and not looking at just what is just for people, or felt like just for people, that that you are starting to look at the debt levels, and I think that I've said that all along since the financial crisis, that just trying to send more money into the system and encouraging people to take on more debt when the problem is debt, that sounds like ludicrous for me. And it's like, because they expected to get this positive spiral going, so they had people to spend more, and then the system, the system should heal itself, and the debt to GDP levels should be coming down. But we haven't seen that. We actually seen that they have kept infusing more and more money, and we have seen that the debt levels have been going up, and they haven't seen that kind of growth that they needed for that. So it didn't work. And that means that you need, instead of doing something indirectly in terms of trying to infusing money to spur growth, you should actually do something about the debt levels. And that means if they had done that already during the financial crisis, I think things would have turned out differently. But now we have the sequel now, because the debt levels are way too high for the world, and that crush will be crushing on world growth. And so the only thing there is will be to go through deflation, do some deflation, or it will be fair and good for the system also, but also to having some restructuring and having default, also letting that happen. It's okay, it's a part of the economy also. I mean, you don't want to have a wildfire, but you need to see sometimes that there is a small fire that actually prevents that you'll have the forest gets too dense. And that's what we need here as well. We need to see that the system purifies itself, and not trying to save every situation, and by printing money. And that's what we've done for that's 15 years now, and it's coming to haunt us. So I would say we need to get into what can we do to restructure debt levels, not encouraging people to take on more debt, but actually bringing it down to a level where we can. And that debt forgiveness will also be part of it. That is needed for the entire world system to to get to a situation where it can grow again. But it's not so politically viable. It's simply too direct, and that you are giving a debt relief. And that sounds like not just to anybody else who sits with a lot of debt on their back.
Yeah, I feel like there needs to be enough pain so that because if you just relieve certain debt, people will probably just go out and, and get more debt and maybe expect that in the future as
Oh
well.
yeah,
So yeah,
exactly. But and you see that with Greece. I mean, we they solved the problem, the Greek problem, and what they did actually was not that they brought in a whole lot more debt, if you see that, but they brought down the payments, the interest rate levels, because they just said, okay, we'll stand behind that. But you just brought on more debt now, and you didn't get the you didn't solve the real problem of that. So that's why I think if they try to do that one more time, that's going to come out really badly. And as there when you have a system, when you have a system that is floated with money, and which has been where growth over the last many years have been brought about, or boom has been brought about, yeah, has come to reality by money printing, then you will normally see that you need to bring an end to it, or the system will bring an end to it by itself. And I think we could get into a situation where the system will do that, and that will be through a more devastating stagflation, and like that actually the real end game to this will be stagflation by the end of it.
And what assets do you think would protect wealth during that period?
So I think, again, this is where it'll be very difficult for to navigate over the next coming months here, because if I'm saying first you got a deflationary bust, then you want to be long the dollar, and you want to be long TLTs and bonds. But if I'm right that we are then going to see somewhat of a more stagflationary development, you absolutely do not want to be long any of those. So you need to get out of that at the right time, and there you need to get into precious metals or into commodities. And I know a lot of people have been talking about that for a long time, but it seems like they kind of were too early, a lot too early. I think there'll be a fantastic time to buy gold and silver. I don't think it's now, but I think there will be a fantastic time to go buy gold, silver, and miners and the likes. And if you're in that at the right time, well, the last time we had stagflation in the world, you saw gold going up 5 times within, year and a half, 2 years, 2.5 years. And I think we could see something similar to that this time around. Not from these levels, but still a lot up from the levels that get to.
Yeah, makes sense. So, Henrik, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Well, I think people should be careful, because there is a very big chance of getting caught in this first in the move up here now, and then, oh my God, Henrik was right on that, but also then understanding that there is an end date to that as well, and that even that end date will become another kind of game also, because it's not the similar kind of play that we're going to see as played out in the financial crisis. So the whipsaw effect of what we're going to see here is going to be very, very difficult to navigate in. So take care out there.
Yeah, it's just not one or the other. It's a very fluid, market and economy and world really. So, anyway, thanks again for your time. Really appreciate it. If anyone wanted to find more about your work, I know we've mentioned the report. Is that the best place people can find it?
Yeah, the Zeberg Report is probably where it's best to, if you want to sign up there. We got live shows every Sunday, and I also answer direct requests on charts and answer questions. We have also a community on Twitter, so that's where, and also you can also try to reach me on Twitter. So that's basically where to get hold of me.
Perfect. I'll put that in the description below. But thanks again for your time.
Thank you very much for having me on.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.